Between dividend paying stocks and capital gain stocks in Nairobi Securities Exchange, which one is better for steady income? That is a question I get asked many times through my inbox and through people who come to my one-on-one session. Now, when comparing dividend paying stocks and capital gain stock, it helps you to think of them as serving two different financial purposes. One is for income today, and another one is for wealth tomorrow. Let's take an example. Dividend paying stock. They are more of income focused investing. They are companies in Nairobi Securities Exchange, and you know them, Kina BAT, Kina Standard Chartered, Stanbic. They are companies that share a portion of their profits with shareholders. They can do that once or twice. Some companies pay interim dividend and others pay final dividend. And there are quite a number in Nairobi Securities Exchange. I've talked about BAT, that is one of the best. In fact, if you are a dividend investor, and for those people who come and tell me, Wajiko, which companies have you invested in? One of them is BAT. As a dividend investor, I would advise you, pick BAT. At the moment, the price may be quite high because it's 570, 573 today. So it was trading, was it 573? Wait for it, for the book closure to happen on 8th May 2026, which is next month. Normally, after book closure, the price of the shares go down. And also next year, during election, accumulate as much as possible for coming years' dividends. So, for dividend company, you buy shares, and then the company make profit, and they pay you dividend when they make profit. So, they're ideal for steady income because it's like you are getting regular cash flow. It's not regular as in you are getting per month, but you can get it twice in a year or once in a year. And then that steady income is more of predictable return from established company. For capital gain, you can enter a share today hoping that it will go up, and it never goes up. So, but for dividends, you are assured that you are going to get your dividend. Assume you buy BAT today, by 12th June, you'll get that dividend of 60 bob that they declared the other day. So it's more of a predictable return. And then I call the dividend investors more of, you're not relying on selling your share to get income. You wait for the dividends to be declared and you get your dividend. And these dividend stocks, by the way, they are very popular with people like me who are looking for retirement. You want to be earning that cash flow. They are popular with people who are income focused investors. You want that steady income. And anybody whose goal is to build passive income streams, dividend being one of them. Then we have the capital gains. The capital gains, they are more of growth focused investing. You are buying a share today, expecting it to hit a certain price, and then you sell. Their main goal is price appreciation and not income. And if it's income, it's income today. The income that you make once you sell at a higher price. So there's no regular income with that. If you enter Nairobi Securities Exchange with the goal of capital gains, maybe you buy BAT today at 500, tomorrow it's 570, you sell. So you don't expect any income next year in terms of dividend. And then the other thing, you have to sell to make money. Remember what I told you. Whatever you see in your portfolios, there are paper losses and paper gains. For you to experience the real loss, you have to sell. For you to experience the real gain, you have to sell. So you have to sell your shares to make money. And sometimes prices can be volatile. So how do smart investors do? They come up with a balanced strategy. where you give like 60 to 70% of your portfolio to those strong dividend payers. At least you are assured of income stability. Then 30 to 40% you can give it for capital appreciation or for those growth stock. And this way, at least you are assured you have dividends every now and then coming. And also, you can also enjoy capital gains. And by that, there are good companies in Nairobi Securities Exchange. They are more of growth stock and also dividend. Take an example of Safaricom. Safaricom, by the way, has never paid a dividend of more than 2 bob. It has never. But if you check at that share, and depending on the expansion and the growth, it's a share that can grow. Currently, it's trading at around 28, 29. It's a share, even there's a time it hit 44 bob. So it's a share inalipa shareholders pesa kidogo in terms of dividends, but iko na potential for growth. It can even become 50 bob, even 100 bob, with how it's expanding in terms of services. Equity also, it's expanding every now and then. Their dividend yield, as I told you the other day, it's around 7%, 6%, 8%. I've never seen it going beyond 10% like BAT. But it's a company that has potential for growth. It can give you good capital gains in the future. So a smart approach is to combine both and have a balanced strategy. Thank you.